It is a great honor to welcome Professor Allan Timmermann, Dr. Harry M. Markowitz Endowed Chair of Finance and Investing to discuss the topic, Economic Forecasting Demystified, What Can and Cannot Be Predicted in Economics and Finance. Professor Timmermann achieved his PhD in economics from the University of Cambridge, a Cand. Polit. From the University of Copenhagen, Institute of Economics, and an MSc in economics from the London School of Economics, or LSE. He has also consulted for a variety of international banks and investment institutions, including the European Central Bank, the Federal Reserve, the Bank of International Settlements, and the IMF. Without further ado, I will happily hand it over to Professor Timmermann.
It's certainly always fun to be asked to talk about a topic that you are passionate about, and I love forecasting in economics and finance. I have a book on economic forecasting, and I'm always eagerly following both very impressive forecast, as well as just the opposite, as you will see. And so what I'll do in this talk, well, it's late on a Friday afternoon in my time zone in San Diego, and not in Aaron's time zone, which is actually early in the morning, but I'll make sure that I do my best to rule out that you fall asleep, and that it'll be a lighthearted, if not quite happy hour talk, then nevertheless, hopefully entertaining topic. And feel free to interrupt and come with questions as we go along, and we can, in addition to that, then we can also take questions at the end, of course. All right, so I will start by sort of giving you a few lighthearted examples of events that economists spectacularly failed to predict. And so Aaron mentioned that his alma mater is also London School of Economics, and I was there somewhat before him, but nevertheless, we both share our passion for the place. It's a great place. And we're not the only ones who have visited the LSE. In fact, during a visit to the London School of Economics in 2008, after the global financial crisis had broken out full flare, she asked the kind of logical question to this gentleman, you can see, who was a professor of management, I believe, at the LSE. If these things were so large, how come everyone missed them? And you can't blame her for her sense of logic, right? It was certainly viewed as a blemish or spot on the track record of economists that nobody really predicted it. Although, as you'll see, somebody made a lot of money out of it, so they must have at least thought that it was on the horizon. And it's fair to say that as early as the summer of 2007, there had already been some signs of problems in certain corners of the financial markets. Quant hedge funds were having a very bad August that year due to some, of their strategies that blew up in their faces. But and there were early signs, of course, also with Bear Stearns in the earlier part of 2008 that were having problems. There were some signs that all was not well. I should say that the Queen was kind enough not to send the LSE professor to the Tower of London, despite his failure in predicting the outbreak of the global financial crisis. Now, that's not the only screw up, so to speak, of the big events that economists, in fact, have missed or failed to predict. There's a lengthy list. And I'm by no means attempting to be exhaustive here. But one spectacular event is, the stock market crash in October 1987. Now, stock prices dropped by more than 20%. I think it was 22% for the major index on a single day. Now, interestingly enough, the options markets had actually been concerned about this risk, crash risk, right? So put option prices in particular, which insure you against these drops, they had actually gone up in value significantly in the sort of early to mid part of the year. But then when no crash happened, then they kind of call it off and say, well, we were probably wrong on it. So I think by August or so, production prices then called it off and said nothing's going to happen. And guess what happened then, of course, in October, was that, yes, the market crashed, and spectacularly so. Now, there's a sense in which, so there's bad predictions and there are also false alarms, right? False alarms is when you cry wolf too often and nothing happens, right? So the old joke is that the economics profession have predicted 10 of the last 5 recessions, right? And there's certainly some truth to that. The COVID-19, well, actually, let me just also dwell a little bit on the stock market crash of October 1987, because even to this day, we're not exactly sure what triggered it. The US government actually established the so-called Rady Commission to explore what had caused it. And, you know, there was no major event or news that triggered it. There was a major, sort of a small geopolitical flare-up regarding an oil platform in the Persian Gulf, but I mean, nothing major at all that you don't see at other points in time. So we suspect that it had to do with so-called program trading that involved portfolio insurance, whereby, you know, companies would sell stocks when prices started to decline, and that would mean that there would be further downward pressure on prices after an initial drop. And if there wasn't a lot of liquidity to create a cushion, then that could possibly have created this sort of sustained drop. But we're talking about the overall market here, so there's probably also some other factors that played a role, but we don't know for sure. So if you can't tell after the fact what triggered an event, then of course it's hard to blame you for not having predicted it, right? So there's certainly that. More recently, of course, the COVID-19 pandemic. Should we have predicted that? Well, I mean, we certainly should have been. I think most people agree that we should have been better prepared after SARS and MERS and various other coronavirus events. We probably should have put in place better, monitoring systems, and so that we would be able to, see if things were spreading and becoming couldn't be sort of like locally contained. We didn't do that, even though actually a lot of people have talked about how we should prepare ourselves. Hopefully we will not make the same mistake next time round, right? But still, it's that what economists call a low frequency or rare event. So you can't really be expected to predict rare events precisely. And by that, I mean, the year, the whole anatomy, how it evolves, its trajectory, etc. It's like earthquake forecasting, right? We can say that an earthquake happens with a certain historical frequency, say every 30 years in a certain region. I'm told in San Diego, it's more like every 400 to 500 years, where the San Andreas fault starts shaking up and giving rise to big earthquakes. Hope that's true. But we can't really say, is the next big earthquake going to be, in 2022 or 2045? If it happens every 500 years, it's, we don't have that delicate accuracy. Another thing that where economists have traditionally been very, quite poor, I would say, is in predicting turning points or recessions, right? And so you can see that I have this graph here from the Survey of Professional Forecasters, and they asked this is a big survey that's run by the Philadelphia Federal Reserve Bank, and they ask economists, so what do you think is the probability of negative real GDP growth next quarter? And then they create this anxious index, right, which is similar to sort of like the VIX, which is the fear index. And the gray areas are quarters that after the fact were deemed to have been recession periods. There's this committee called the NBR that actually goes in and says, oh yeah, typically 1 year after the fact, we were, they can say, well, yeah, this is deemed to be a recession period. And what you'll see is that the probabilities that are plotted here, so on the y-axis you have probabilities going from 0 to 100, they do go up during recessions, but they typically don't precede them. So for example, look here in the 2008 global financial crisis, before it, on average, the probability of a recession is about 1/6. So it's about 15 to 20%, and that's exactly what it was, right? So these economists certainly didn't see it. Then they sort of realized that, oh, yep, there's actually, we're in the middle of a deep recession with sort of like 1 or 2 quarters delay. Then they think, oh, we are on our way out. And then they realize, nope, this is going to be a long one. And then it spikes there at 70% before coming down. And you can see during the COVID-19 pandemic, even there, it was particularly hard. They didn't see it coming, of course. And then, they were still extremely uncertain in Q2 and Q3 because of the enormity of the fiscal and monetary stimulus packages that were preceded there. But I think the key point is actually in the detail here, where you can see that, if anything, the economists' probability assessment of a recession tend to be a lagging indicator. It kind of spikes after the fact or towards the very end, rather than a leading indicator. They don't typically predict ahead of time, and most of the time they, and sometimes actually, by the way, they call false alarms. So this is an example where they double the probability of recession in 1988, and that was after the October 1987 stock market crash. They didn't know if that would lead to a major recession. It didn't, as it turns out, but economists weren't sure at the time. Yeah, so you can see that we don't have a terribly good track record when it comes to predicting turning points ahead of time. But there are examples where we have been stellar. So here are some spectacularly successful forecasts, at least by some. First one is George Soros, who's a famous hedge fund investor, who who broke the British pound on September 16, 1992, where he earned a cool $1 billion, supposedly having a hugely leveraged position against the pound. He was betting that it would depreciate against the European currencies. And it was not an easy bet by all means to take up, because billions and billions of dollars were put at risk, right? It didn't, this depreciation of the British pound did not happen as quickly as he had expected, but he managed to hang in there, and then in fact is so famous because he earned $1 billion supposedly on this position there, betting against the pound. The US subprime mortgage market crisis leading up to the Lehman default in 2008 made a lot of money for hedge fund manager John Paulson, right? And so he certainly was one of the people that were betting on falling fortunes, certainly in the market, yeah. And a couple of more esoteric forecasts. So Kansas City quarterback Patrick Mahomes, is supposedly, I read somewhere, he was predicted to win the Super Bowl in his high school yearbook. And it actually happened, right? Now, later on, we are going to come to the point, how many high school students were actually predicted to win the Super Bowl in their high school yearbooks. So we'll come back to that point. Maybe even more impressively, here's an elephant that has predicted the outcome of World Cup games. So you can see that there's a ball here, looks a bit flat, 2 goals, and then you can see, I guess this is the German flag, and here's I can't quite see what's the Senegal maybe, Senegal flag, and if the elephant kicks the ball into one particular goal, then that's the team that will win. I guess it probably gets a couple of chances, the elephant, in case it doesn't hit the goal, or in case they want the actual score, right? But it's not the only one, as it turns out. Not only elephants, but squids can do it. So here's In fact, a story about how during the 2010 World Cup, Paul the Octopus gained stardom because he correctly predicted the final between Spain and Netherlands, as well as going 11 for 13 with his forecast of Germany's results. And but he was beaten by Nelly the elephant. I think this is probably Nelly, who went 30 for 33 in her picks of the 2006 Women's World Cup. So people talk about psychic octopus. And by the way, in case you don't know, octopus are supposedly very intelligent beasts that can actually learn. For example, if you have two octopi in a tank with a mirror and a dividing glass wall, one octopus seeing the other one opening a can or doing something tricky, it can apparently learn from that. So maybe it had learned from its masters reading the sports pages while it could look over their shoulders. I don't know. But now, so seriously, of course, I mean, here you know that this is just, there's something wrong, right? I mean, there's no way an elephant or an octopus can actually predict, but we'll see. We'll come back to that point. So going back to the realm of economics, what are the variables that can be predicted fairly accurately most of the time? Well, I will start with some variables that have a distinct feature, namely seasonality. So most of the time, electricity usage by hour of the day, day of the week, week of the month, month of the year, can be predicted quite accurately. Now, of course, don't mention Texas, where they're having a horrible situation right now with record low temperatures, but that's in part a supply problem that they're facing and hopefully getting out of. But obviously demand has spiked also because of the extremely low temperatures. Normally unemployment and employment rates can also be predicted fairly accurately. But again, don't mention COVID because that caused some unprecedented rapid shifts in them. Yeah, demographic variables like populations, number of births, number of deaths, overall population in different age cohorts tends to evolve very gradually, highly predictable as well. Normally, sort of like next quarter GDP growth is something that's not too uncertain for the world as well as for specific countries. The IMF predicts that in their World Economic Outlook, and things like, and interest rate levels also tend to evolve fairly smoothly most of the time. So let's look at electricity usage and the way in which it's actually predictable. So here I have taken from the Energy Information Administration some plots that show the average hourly US electricity load during a typical week for a few different months. And what you'll notice, so here first of all, you notice that, so you have Monday through Sunday, right? The patterns are very, very similar Monday through Friday. But then they become dampened on the weekends when people are not commuting and not working, but they're staying at home, right? You'll notice this sort of tooth-like pattern here. So, you know, it's sort of like peaks here are early in the morning, then in the midday it goes down, and then it comes up again. That's a pattern you see in January, but not in April, certainly not in July, and not in October, right? There's something unique about January, but it repeats itself so weekends are very different from weekdays. And you can see that this hourly pattern here, it's very pronounced, a little higher on Mondays than Fridays, but it's extremely irregular. April, July, and October, you see this single peak every day, and again, lower consumption during weekends. And this pattern is extremely repetitive. And it has to be, right, because electricity suppliers have to match electricity demand and supply, otherwise the grid goes down, as they were fearing would happen in Texas, right? And when that happens, it's very costly to start it up again. So you have these very pronounced and very repeated patterns. So for example, on Monday morning, people tend to start the day half an hour later than Tuesday through Friday, because, you know, maybe they had a good bottle of beer or a glass of wine on Sunday night, they're relaxed, and then, they take a little extra time to get started. And Friday, you can see that is a little lower than the other days also, because maybe they go home early. Now, these are the same colors as you see. So you can see, for example, take California. So yellow, that was July, right? Blue was January. So you can see how the curve within the day even changes, right? So in July, you can see that there's a much bigger peak at 6 p.m., a single peak. And that's because, people come home, and that's when the sun is about to set, I guess. And they turn on the AC when they arrive home from the office. It's literally that, right? And it's so regular, so they can be easily predicted. This strong, what people call diurnal or seasonal pattern. So the seasonal pattern is highly predictive, and it's very important for economic activities, for energy suppliers, for reliability of an alternative energy sources, etc. Even for companies deciding on opening hours and things like that. Incidentally, they are changing these patterns. So, for example, I was just reading a paper from University of Pennsylvania that actually found that the temperature spread, which is the difference between the max and the min temperature, has actually come down during the both during the spring and fall across U.S. cities over the last 20, 30 years. As a result of probably global warming. So what's happening is that the lowest temperatures during spring are not quite as low as they used to be. So the span between min and max is lower now. And during fall, I believe that the peak temperatures are a little bit lower than they used to be. So also the differential has become smaller, right? So if you feel that, the days are not quite as hot as they used to be in the fall, and they're not quite as cool as they used to be, the minimum when you start out in the morning. In the spring, you're actually right. It's actually happening, and it has to do with this whole, I guess, at least one hypothesis is that it has to do with, the way that, everything, cloud cover, etc. is changing. It's not just the average temperature, which clearly is trending upwards, is actually also the difference between the high and the lows, right? And that will affect how people, dress up, how they, plan their activities during the day also, right? So there's a lot of interesting questions that, although this is changing very, very slowly, of course. So here's some, so that was electricity. Here's some other variables that we can predict most of the time. I already mentioned some of them. Unemployment rate, because you can see it evolves kind of smoothly. This is going back to 1950, monthly data. The employment to population ratio, which is how many people that could work are working. So you can see that it was up at 65% in 2000, and then has come down, but it comes down, usually it comes down quite sharply during recessions, because people stop looking around for a job because they can't find one. But then look at COVID. Look at COVID here. The unemployment rate is just shoots up. So that's why I say some of the time, right? And you can also see the quick changes. So unemployment goes down, unemployment goes up, employment goes down during recessions. So that's the harder one to predict. Here's a rail freight carloads, and you can see most of the time we can it's fairly stable there, but then you have the drops here, and look what happened during COVID. And this is the inflation rate, and inflation has been very hard to predict during COVID again, and it still is today, right? It depends on whether the Fed has its way or not. So what's common to variables that can be predicted? Well, they sort of have a stable, smooth, or persistent component, like, the unemployment rate during normal times, sort of where it goes up and down and so forth. But then, of course, around these turning points, they become utterly unpredictable. We looked at the electricity usage, and that had this very strong repeated seasonality, both within the day and across days, weekdays versus weekends, and across months. July is very different from February, right? And there's this sort of like mean reversion towards sort of the average. And they're also characterized by friction. So for example, if you look at labor market variables like these, right? Most of the time, this is monthly data, right? So most of the time, the unemployment rate doesn't move suddenly from 7% to 10%, although during COVID it sure did, right? Most of the time it doesn't do that, simply because of frictions. Hiring and firing people take time and it's costly. And so it's kind of relatively smooth. And that actually then brings me to this point. Well, the outcome variable for it to be predictable is not a traded, a liquid asset price. So in other words, you can't make money by improving forecasts, as you'll see. Now, I'm certainly not claiming that it's impossible to predict prices. Look at these guys. It's electricity prices. And you can see they have a clear pattern here, right? So they sort of spike around July and then they come down again. July, where everybody has their air conditioners turned on. And so the demand is high relative to supply. Why does this sort of predictable pattern not go away? Well, it's because of the nature of the constrained supply, right? The demand may peak, but the supply can't go with it so easily, right? We can't supply new energy at zero marginal cost or low marginal cost. And that's why the price will have to go up so as to reduce demand and make sure that demand equals supply. So that's what's happening here. But again, you can't make money on it because unless you have very strong legs and very strong bicycles, so you can sort of start generating electricity and somehow take advantage of that, which of course you can't do in practice. What about variables that are very difficult to predict? Well, here's a list of some returns on liquid assets where if you could have predicted those prices better than others, future movements, you would have made a lot of money. And therefore, well, everyone who has the ability to predict these things, of course, go and do it. And then the resulting price incorporates and bets all that information, yeah? Same thing with performance of mutual funds and hedge funds. Suppose you have a very smart fund manager that can outperform others, then more money will flow into her fund, which means it becomes harder and harder for her to outperform because she suddenly is saddled with all this money to invest. And every time she does a trade, it'll have a large market impact because she has so much money to invest. And so that means that any sort of initial advantages she had will go away. Price of appreciation for an individual house, I mentioned that because there's so much uncertainty about what we call it neighborhood risk, right? And so it's a very idiosyncratic component that makes it hard to predict. And then even changes in inflation because of large shift in monetary policy and supply shocks. So here's one example. Also, I mentioned commodity prices. Look at crude oil prices. So I was listening to Bloomberg's webcast and the Economist webcast when I was walking my dog this morning, and they were talking about, some traders think that $100, we may be back to $100 per barrel oil prices sometime in the not too distant future. Key thing here is the not too distant future. They don't want to say exactly when, right? Here is another thing, which so I know that Joey gave a talk about behavioral finance, and of course, consumer sentiment is also about that kind of thing with behavioral psychology, and you can see here how erratic that is, how quickly it can shift, right? It can go down very quickly, as you see here. Now, here are two other series that you can see. These are variables. I will reveal its prices going back to the beginning of the year, and I'll ask you to identify what this one is. So this one has topped out now at 54,000. So what do you think it is? Any guesses? I think you're on mute. You can see it's kind of erratic. It's been going up most of the time, a lot of news coverage, and then it came down a little bit, but most of the time it's been going up.
It's a Bitcoin.
It is Bitcoin. Very good.
Great.
Very good. But you can see, I mean, okay, it's mostly been going up, but it changes very quickly. And, even within the day, it can actually change by a lot. What about this one here? You can see the price goes back to January. It's skyrocketed here in late January, and then there's been kind of flat since then. Any idea? It's a stock price, I will tell you that. It's been in the news a lot.
GameStop.
GameStop, you bet it. It is, yeah. GameStop, right. So you don't want to have bought here and gotten out there. So yeah, GameStop, right? So look at how, suddenly you get this this spike that then, quickly goes away, and then it respikes and so forth. So yeah, no, this is pretty crazy. And look also with the trading volume, how wild that was. So yeah, so these are prices, right? And it's because you can make money out of it that is so hard to predict, as you'll see on the next slide. But another thing that I wanted to bring up is actually even, I mentioned COVID having made it very difficult to predict outcomes, yeah? And what this shows is actually, this is, together with 538 and a colleague from Johns Hopkins, Jonathan Wright, and University of Chicago, we actually conducted these surveys of a group of academic experts that we asked to predict the outcome of the US economy. In this case here, it's the quarter-over-quarter GDP growth in the fourth quarter of 2020. Now, one thing that you should be aware of is that normally when you get closer and closer to the date you're predicting, then you get more and more information, and then it becomes easier to predict it, so the uncertainty shrinks. But look at what happened here, right? So, early on, this is in May, and round 1, and round 10 was in October. So October, in fact, you were very close to Q4, right? Even early, had a few days observations of Q4. But you can see that there was enormous uncertainty as showed by this upper and lower band estimates, right? So it was so hard, and I can tell you it was really the case. We had no clue. Even in October, we had no better idea of what would happen to fourth quarter growth last year than we had in May. So this is highly unusual that this uncertainty kind of persists. So what's common to these unpredictable variables? First of all, there's sort of like little or no persistency. So they're actually very sensitive to large sudden shocks. Oil prices is the perfect example, right? They even dropped to zero earlier in 2020. The other thing is, rare events like the global financial crisis, like COVID, like the Great Depression, because we just don't have a large training sample on which to, set up our models to try to predict these things. Now, there are efforts trying to do that using international data and asking whether, hey, can we actually predict the next crisis? So Ellen Ray, who's a professor at London Business School, she has a very interesting paper where they use machine learning to try to do that. But the reality is that, predicting the next crisis is very hard because every crisis is unique. Every recession is unique. So strong feedback from forecast outcomes. Well, imagine it's like an opinion poll. Suppose that you ask somebody, who are you going to vote for? What political party? And then they tell you their honest answer. And then when they see the poll, then they change their mind. They say, I'm not going to support this candidate or this party because, their share of the vote is higher or lower than I expected. And so if seeing the poll actually changes their original behavior, then the poll can't really be right, you would think, right? And it certainly would be hard for it. Same thing here. If there's a feedback from forecasts to outcomes, then, and forecasts themselves change economic behavior, then the original prediction is undermined. And so that's why when people ask me, can central banks forecast crises? I said, no, not if they can prevent them, because that wouldn't happen, right? So yeah, there you go. It's just sort of like a conundrum there. But more broadly, if you can make money out of forecasts, then you give incentives for people to do their very best to try to incorporate the most accurate information and spend lots of resources on acquiring and processing information, which is why changes in stock prices, returns in stock prices and financial markets more broadly is such a hard thing to beat, to outperform, and why, as we saw in our finance class, the best predictor of frost in Florida is the OJ futures price, because that's where you make the money if you're good at predicting frost. You don't make the money by being a weather forecaster on the local NBC channel, right? Here's an example. It's a nice article from the Financial Times, which talks about how BlackRock at the time was setting up a sort of a machine learning lab. But the important part of this quote is actually what it says here, namely that quantitative managers are engaged in an arms race, as data analysis techniques that work today will not necessarily be relevant in 5 years. Why? It's because everybody will be using the same machine learning techniques, and then their ability to predict should then have gone away. It's almost like machines playing chess against other machines, and then you hope that you have the faster thinking, better chess player, or in this case, trading machine, right? But that's this point about forecasts, this forecast methods actually influencing outcomes. So I talked about, initially and by the way, are there any questions at this point? I should pause a little bit to give you a break. Okay, no questions. Yeah, we can take them at the end. That's totally.
Do you have any insights into the success of Bitcoin that might not be in the news?
Broadly appreciate. Well, yeah, I mean, it's hard, because so many things have been said, both good and bad, about it. To me, I think personally that it's sort of like highly unlikely for a currency that is so volatile during the day, even for it to become sort of an important means of payment or storage of value, because if it can change by 5% easily within a day, I think that you wouldn't want to use it as a means of payment. Imagine you jump into a taxi or an Uber, and then when you arrive 1 hour later, then actually the price has changed by 5% just as a result of Bitcoin changing its value. And it's certainly true that it has been going up, but also don't forget that one thing that's sometimes overlooked is, we're all talking about switching to electric vehicles and making sure that global warming is not happening as quickly as would otherwise be the case. Well, guess what? A lot of resources and a lot of computing energy is going into mining Bitcoin, right? Particularly now where the value is so high, then the marginal amount of mining you need to do and electricity consumption you need to consume has actually gone up. So even, I think eventually people are going to start thinking about that, also the environmental costs of mining Bitcoin. And I think there's some studies that even compare the total energy consumption associated with mining Bitcoin to very substantial consumption by companies, I mean minor countries. So apparently, I don't know if they are credible, but apparently that's a concern. But for me, given the fact that it's until Bitcoin becomes accepted by regulators and supported by regulators, it's still at least going to be risky to hold on to it, because if regulators suddenly go in and outlaw it, then it will not be viewed as a legal tender. And I think there it's interesting to contrast it with, for example, this electronic renminbi that China has just launched, right? By law, it will be, all merchants, I guess, in China will have to, as I understand it, will have to accept it as legal tender. So you can't deny it. And so basically you will be able to go to your Chinese bank and, take your cell phone, put it, charge your account by so many renminbis, and then you can just hold it up and pay for it anywhere, for any store, right? And so that will give you, it'll be an electronic currency supported by a highly influential, strong central bank, Chinese central bank, right? And I don't know how, for example, Bitcoin then will be viewed in comparison, right? Because they don't have the same approval or backing by a central bank and a regulator as this electronic renminbi has, right? So, and of course, competition in the space, etc. So there's so many uncertainties. So, I can certainly see, as people's confidence in the currency go up and down, and as people like Elon Musk announced that hey, they've invested in $1.5 billion, Tesla has, of Bitcoin, then of course that will lift the price, but then other events might do the opposite. So yeah, so I still think that there's a ton of uncertainty there, and it will continue to be volatile in the near future. All right, so do economic forecasters have skills? Well, academic research by some very established and highly respected academics have certainly argued that there are such things as super forecasters who have extraordinary judgment and an innate ability to produce accurate forecasts and reduce the human biases. Here's the bestseller from the New York Times by Phil Dedlock. It's a terrific book. I can highly recommend it, called Super Forecasting. And the idea is that there are some of us that have these innate abilities, and it could be your pizza delivery guy. It doesn't have to be a field expert or a person with domain expertise. It could actually be that just an ordinary people have for some reason they don't have biases, or they can be trained not to have biases. The problem is that when we look at forecasts, they're reported for multiple variables, global outcomes, economic growth, financial markets, etc., by many forecasters, sometimes beasts as well as humans, and many time periods. So the reason why I started off half jokingly with the elephant and the squid is because you could all say, hey, of course they don't have any predictive skills. But what if I had told you that it was an esteemed, hedge fund manager? Said, oh, this guy, he really did well. What about George Soros or John Paulson? Was it skill or was it luck? It's easy to be fooled by randomness because you really, the media, of course, tend to focus on these spectacularly good or spectacularly wrong forecasts. And now, so this is related to, fake news meeting forecasting or data mining. In the science, in the social sciences and sciences more broadly, we now call it p-hacking, as in p-values, right? When you come up with a result that shows, oh, I can predict this or that, but in fact is the result of selecting sample criteria and test methods in such a way that what would otherwise be insignificant actually becomes a significant finding. Yeah. Peter Coy, who's one of my favorite writers, he now works for Bloomberg also. He characterizes this way. He talks about how researchers have more knobs to twist in search of anomalies, which are these findings you can trade on and make money on, by simply changing the sample periods, the number of firm characteristics you're looking at, what have you. If you don't find anything, you don't report it. That's known as the file drawer problem in sciences. Only positive ones get published, or at least there's a bias towards doing it, or turn it into an investment strategy. So we have to be very careful because, as humans, we tend to sort of favor findings that are spectacular. And sometimes we can tell that the finding can't be quite right. I remember the finding that people, this was based on mining Facebook data, people who prefer curly fries over straight fries when they go to, I don't know, In-N-Out Burger or McDonald's, apparently have a higher IQ. So there there's something weird, right? But countries with a high chocolate consumption tend to be countries with a very high proportion of Nobel Prizes in the sciences. Why is that? Sweden plus Switzerland takes care of it, right? So you have to be careful, to point it out. Other times, it's harder to tell what's driving the results. Now, I have some research by with the two, a current PhD student, Ritong Q, that you'll know, my RA, and Yin Chu Tzu, who's also graduated from Rady with his PhD, and who is now at Brandeis University. And we look at Bloomberg surveys of 14 economic variables, covering hundreds and hundreds of predictors, of forecasters. Sometimes we conduct more than 1,000 pairwise forecast comparisons, forecast evaluations. So we basically compare every single forecaster with another one. And then we also compare it against the equal weighted average. We conduct, literally thousands and thousands of these comparisons. And then we have a statistical procedure that allows us to tell if good performance is due to skill or luck by adjusting sort of like the critical values, because you conduct these, thousands or tens of thousands of forecast comparisons. And we find very little evidence that any forecasters had superior skills relative to the equal weighted average. Although they are actually better than simple statistical models. So they are skilled, they just don't have superior skills. So it's like, imagine you go to a sports event like Tour de France in bicycling, right? Should you go with a superstar rider that is trying to win the race, or should you go with a peloton? Peloton is like the equal weighted average here. There's a long tradition in economic forecasting finding that it's hard to beat the simple equal weighted average. If you go to the medieval ages, sometimes they would have a big bull in the central marketplace, and people would be asked to guess, what's the weight of this bull? Is it 800 pounds? Is it 1,500 pounds? Whatever. And people would come up with these crazy guesses that would be completely wrong. When you took the simple average of forecasts, some were too high, some were too low, it was almost impossible to beat it. Wisdom of the crowds, sometimes we call it, right? And so what we find here is that go with the peloton. So in other words, this is actually showing that the simple average forecast, which sometimes called the consensus, is actually very hard to beat. And this is just showing that actually, sort of some histograms, I can skip over them, showing that the values, basically these forecasters beat the simple autoregressive models, but get beaten by the mean. Now, so this is sort of like showing you some of the spectacularly successful forecasts and unsuccessful ones. So certainly it's true to say that economic forecasting has a mixed, somewhat blemished track record, but I think the game is changing now. We're getting these new gigantic data sets and new, very powerful machine learning predictive analytics methods. Now we have fantastic macroeconomic data we can use to track and predict economic outcomes at a high frequency. If you think about Google or Apple mobility, right? Google Trends that can measure sentiment. I have a new paper where we look at how much predictive power or house prices you can get from looking at searching for a house. Very, very strong predictive power, because people start searching way ahead before they buy a house, right? Months, in fact. And you have large cross sections of data by, MSA, by metropolitan area, by, cities, types of firms, industries, etc. And now we can suddenly start mining it. And then we don't have small samples anymore. Remember, one of the key reasons for failure in economics is when we have a bad or limited library to train our models on. And so machine learning methods really sort of change that. Now we can, in principle, if we have large enough data sets, we can go in and analyze highly complex, high-dimensional problems, thousands of predictors and different shapes. And we can, it used to be that we couldn't use these methods in social sciences because of overfitting. We are not good at controlling the tendency to overfit and produce bad forecasts. But now we can actually control this. And so the way that they work, these machine learning methods, is, of course, they go in and reward past good fits and past patterns you detect, and punish if you are not finding any patterns, right? So they're very good at helping to uncover overlooked patterns. But the problem is that in order to detect future patterns, you need to have them also present in past patterns. And we only have a limited library of these historical events, like the long-term capital management default that led to the Asian crisis, and the global financial crisis, COVID-19, etc. The next crisis will almost certainly be different from those. And so, since we don't have future crises in our historical library, that is a problem, right? Unlike, for example, if you use machine learning methods to help a driverless car avoid a crash, you have billions of observations on from multiple cameras, where you sort of see, okay, in this situation, is there another car coming this direction? what are the driving conditions, etc. We literally have all this training data to train the algorithm on. We don't have that here, right? So that's still going to be a challenge. It'll be hard to have machine learning algorithms actually predict generally new patterns that we haven't seen before. Yeah, unless we understand the true law of motion of the economy, in which case perhaps we could do it, but that's harder. That requires theory, right? And what if the future is not like the past? Because we see breaks. I mean, coming out of the pandemic, will things ever be the same post-COVID as they were before? If not, then we can't really use historical data to predict the future equally accurately, right? And so if this time is different, then we really, in some sense, if we knew the law of motion of the economy, would just simulate millions of possible future scenarios and then use that as our training data. But of course, we don't know what actually guides. This is not a physical system, unlike the kind of data that people in the hard sciences have when they want to use machine learning to uncover new patterns. The other thing is in finance, the signal to noise ratio is extremely low, less than 1%, because markets are efficient if you're trying to predict asset returns. And so machine learning methods can easily get tripped up. This is what I called overfitting before. And there's a saying in statistics that all models are wrong, but some are useful, by famous statistician George Box. The problem is, well, useful some of the time, but we don't necessarily know ahead of time when that will be. Okay, so I certainly think, look, I want to end up also on a positive note. I'll say, look, there's very bright prospects for adopting machine learning and forecasting methods throughout the social sciences, everything from urban studies. I mean, I think, even, UCSD, we had I think, a supercomputer center, we recently hired an expert on ethics and philosophy to the supercomputer center. Can you believe it? It's because, I mean, actually, you can imagine using Boolean logical operators, false, true, as a way of, describing ethics and philosophical dilemmas. Wonderful, right? So even there, in the in the humanities, it's also machine learning is becoming a big deal, right? And certainly in social science, everything from studying crime to urban transport patterns to economic spending to production to the impact of weather on transportation, everything you can imagine with machine learning being used for that, right? So it's a huge potential that we barely have tapped into. So I would, strongly certainly encourage you to pursue those, skills associated with using them. But also you have to be a very good consumer, a critical consumer, because when we try so many methods, we'll have all these false discoveries of fake news, so to speak. And this is what data mining that finds these funny patterns that are, sometimes you can tell they can't possibly be true. Fine, it doesn't pass the smell test. But other times it's hard to tell if they possibly could be true, right? And don't forget that the most spectacular findings get most attention. They're the ones that get reported in the news. All right, so I guess I'll take some comments or questions that you may have.
Yes, I have one question. I'm a full-time MBA student at Rady School, and my background is finance and engineering. I'm interested in how to minimize the risk of corporation growth in long-term finance. I'm trying to stack up variables to get right company potential. I'm planning to calculate value of the project using a number of GitHub contributors and the commits that company has. Please let me know anything about the study in this field.
So let me understand. So you're trying to predict the what exactly
company's value or the risk, minimize the risk of company growth.
Okay, so are these companies that are already public, or it's private companies?
Yes.
Okay, public companies, yeah. Yeah, I mean, so certainly people have looked at things like, number of patents, R&D spending, all sorts of variables, right? GitHub is new to me. I'm certainly not aware of any any studies that have looked at that. I mean, people have looked at social media attention and mentionings and all that, trying to, in some sense, free ride on coverage. You can imagine what is seekingalpha.com, which is a very interesting website. Maybe you have some analysts with good insights on the company there. So whether that's so this is about what we call price discovery, right? In finance, as you know, whether you can find price discovery through GitHub. I don't know. I guess it depends on if you. Somehow if GitHub projects, number of GitHub projects would contribute to the company's growth, or there's a certain buzz about what it's doing, it would have to be that. I mean, it would be most relevant, right, for internet-based companies, right? Because you would expect that it could be correlated, because GitHub interest could reveal that this company has, particular company has some really interesting, unique data, right? Whether they'll be able to mine it better than others would then be hard. That's an empirical matter, right? So no, I've not seen any work that have tried to relate that. But that's certainly in the spirit of other studies that have looked at, like I said, Facebook coverage, or social media coverage. Yeah.
Interesting. Thank you.
Sure.
Professor Timmermann, thank you so much. That was very insightful. So there's a famous quote by Mark Twain. It says that history doesn't repeat itself, but it often rhymes. So looking at the COVID crisis, we're in a very ultra low rate environment at the moment. And I guess some economists are predicting that maybe in the next 5 years, interest rates will start creeping back up. And then, of course, when interest rates creep back up, other economic variables are affected. So are economists using machine learning models to kind of see what the central bank is doing and try to make predictions accordingly, or what exactly are practitioners doing?
Yeah, no. So this is a great question, because we really are in a historically unique situation where we haven't been before, and that's why there's so much uncertainty about inflation prospects and gold prices, because gold is traditionally used as a hedge against inflation, although some people have argued that we should be using Bitcoin now. But this is something that's unprecedented, right? So the amount of firepower used by central banks and governments is simply, we've not seen anything like it. I mean, more than close to 10% of GDP growth in the case of the US, particularly if this latest $1.9 trillion package goes through. So of course the Fed is probably hoping that there'll be a little bit of a bootstrap effect, in that by announcing that they will accept interest rates above 2%, inflation above 2% for a period of time, then people will start saying, oh, we're going to have inflation, and then they'll take actions accordingly, maybe spend more now than if they expected prices to drop, and that could sort of be a self-fulfilling prophecy. But we don't know how effective it'll be, because it depends on the rollout of the vaccine. Some people have warned against the fiscal package, like Larry Summers at Harvard, who used to be in the Obama administration, and that's worked, I guess, with Biden also. Others are more sanguine, and sort of, you can certainly see that over the last week or so, the 10-year rate has crept up from about 1% to 1.3%, which is a very big rise for such a short period of time. And so there's certainly some belief in the possibility of inflation going up. But I think it's a case where, in some sense, in financial markets, for them to clear, there has to be as many people on on one side as on the other side, right? And so equally many people also think that, well, no, maybe it's a little too early to tell whether inflation will result. Traditionally, when you inject this incredible amount of money into the system, then inflation will ensue. But we certainly have not had high inflation or inflation expectations, although they're also edging up in recent years. So it's definitely a possible scenario, but inflation is likely to be far from uniform, depending on whether you're looking at the US, Europe that's lagging behind in growth, and also that I think I saw the British Chancellor talking about higher tax rates. Well, that's not something being discussed here in the US, right? Or even the developing world, right, where it's also a totally different situation. So I think each case is unique, and it's definitely one of these scenarios that it'd be great if we could take machine learning here and then simulate it. But we don't. I mean, we just don't have that ability because we don't understand how the model will work. It'll depend on consumer confidence and, like I said, with medical progress and so forth. So yeah, so it's one case where I think machine learning will be very hard to use here, simply because the variables that people typically look at for predicting prices are things like bankruptcies, defaults, credit spread widenings. And we're seeing the exact opposite now. There are actually fewer bankruptcies in Europe than over the last 5 years. So in 2020, there were fewer bankruptcies than what we've seen in the previous 5 years. And in the US, it was on the low side, comparable to what we've seen in a normal year. And also credit spreads are very low by historical standards because so much money is being pumped in. And so traditional, that would normally, if you feed that into a machine learning model that has been trained on historical data, it'll say, oh, smooth sailing, no crisis, right? But it wouldn't know that the reason why those spreads are so low is because of the central bank intervention, because it has never happened before on this scale.
Thank you. Do we have any more questions in the chat? I'll just double check. No, I think that's it, unless anyone wants to unmute.
All right. I will leave you with a picture of the favorite predictor of outcomes. The next time, by the way, going back to that example, I wonder how many zoo animals are actually being tested there, because that it's of course just pure luck. So probably people, zoos all over the world, from San Diego Zoo to London Zoo to, and I think last time was a zoo in South Africa where the World Cup happened, are probably picking several animals. And then they, keep some score of, how many right and wrongs they're getting. And then the one animal the two animals that happen to be lucky in terms of predicting it, they are the ones that get announced, right? So that's how it's happening. So it is, of course, not skill, it's pure luck. And it's because of this data mining. If you look at enough animals in enough cases, some of them will appear to have predictive skills. But don't be fooled by randomness. Thank you.